Hello, Shakti.
Hey, Natalia.
How are you doing today?
How are you?
Very well. Hello, everyone. Today is another exciting day talking about stocks and using our stocks analytics platform and our minds to our knowledge to analyze the company. And what is on radar today? What are we talking about?
So today we want to talk about Meta and the fair value estimate for Meta as of today, and
Yeah.
then also discuss how our fair value estimation model would have performed if we use historical data. So let's jump into the app quickly.
While you are sharing your screen, I want to remind everyone, please like, share, and subscribe, and we will really appreciate it. We are looking at Meta. Beautiful. This
Oh,
is 710 today.
okay, so Meta has done pretty well in the last couple or so years. So I remember looking at the stock price in 2021. In 2021, it was close to 375, and since then, the stock crashed to 90 because Mark Zuckerberg had other plans for Meta. He changed the name from Facebook to Meta, get into the metaverse, and that did not bode well with the investors, and they were not sure how the company would proceed further. And one thing that the market does not like is uncertainty, and that's exactly what Mark Zuckerberg gave them. So the stock crashed pretty hard, almost 75%. But then the management and Mark came back and said, okay, we are still going to focus on the core business
Yep.
and make the profits that we are making and spend some money on our other ventures. And once they gave that assurance, the stock went back from 90 and to 700. It's a 7x, easy 7x for most investors who would have used a fair value estimation to calculate the stock price instead of looking at the daily news and how the company's market price is changing, right? So in our app, currently we show a fair value estimation calculator. It'll tell you at what rate the company should grow in the next 5 years to get the investor 8% returns. I'm using 8%
Yeah.
return because that is the minimum expected return from any stock that I expect. So in that case, the company is expected to grow close to 17% in the next 5 years for you to get an annual return of 8%. And will the company grow at 17%? Nobody knows. But as you can see,
Yeah.
the recent revenue growth, it's close to 21%. So maybe it's possible that the company can continue to grow at that rate. But before making that assumption, it would be nice to see what had happened in the history for Meta in the last 10 years and see if we had used the same fair value estimation, let's say in the year 2019, what would have
Yeah.
happened as the stock price went up for an investor. Yeah, take over.
Yeah, that's my favorite. What if? What if? Okay, let's look and imagine what if we had our fair value estimator back in time and used it and how much money we would make. I'm sharing my quick analysis. So this is basically visualization of actual stock price, a fair value calculator based on our logic and growth, free cash flow growth and revenue growth of the company. On the top, we will see the comparison of fair value. This is the blue dotted line and average for the year stocks price. Shakti, I did select here Meta and I did select growth rate of 17%, 0.17 as you did. And I did selected discount rate of 8%. Now then, explain me what I see.
Yeah, so if we go back to 2019, the stock price was 180 and
Yeah.
the fair value at that time was, what was it?
We assume that growth rate for the next 5 years on average 17%, then it would be 258.
And also, when we say discount rate, it is the annual return that the investor expects. So if I
Yeah.
want only 8% from Meta for the next 5 years, and with the assumption of 17% growth for the company, fair value was 258, but the stock was trading at 180, which means it is undervalued based on these assumptions. So let's
Yep.
assume that I put my money at 180 in 2019,
Yep.
and I now what do I expect, right? I expect 8% growth every year for the next 5 years. That's like close to, let's say, 50%. Now 50%
Yeah.
of 180 is like 90. So I expect the stock price to be at 270 in the next 5 years. So let's move 5 years down the line.
5 years down the line, that would be 2024.
24.
Let's
24.
go 2024.
Let's look at
End of
23
year.
because there was a huge jump after that. So in
Yeah.
23, I see 260. So if you remember my original expectation, I wanted 270 from the stock. Now between this time is when the stock price crashed to 90 and
Yeah.
people panicked and so on and so forth. But if I had believed in my calculations and if I trusted my numbers, I knew that even though the stock is crashing, the market might be mispricing the stock based on news, right? So I don't care
Yeah.
about the news. I only care about the numbers, and I hold on to the stock till 2023, and I see it's very close to what I initially expected. Now it's at 260,
Yeah.
and in the
And
next
you
year I
were
expect
expecting 260 actually.
yeah.
Yeah.
So that's what has happened for Meta. You can do this for many other companies and see similar results.
Look at fair value in 2023.
That is because Meta grew much faster than we originally estimated. We estimated 17% growth, but in
Yeah.
reality, if you look at 2019's revenue growth, what was it?
It was 15%, but look
No,
at cash
2019. You have to look at 2019, 20, 21, 22, 23, right? So if you look at these percentages, it was above 17% for like 3 years.
Yeah.
And then it had a crash to minus 1%. In that particular year, there was the reduction in growth, and that's probably the reason why the stock crashed because the market thought this company is not going to come back up. But
Yeah.
what
Yeah.
happened is it did come back up, and if you look at the average growth across that time frame, it would probably be better than what we had estimated or close to what we had estimated. And when that
Yeah.
happens, and now when you're projecting again for the next 5 years, and again you're expecting 17% growth, the fair value becomes 700, right? That is
Yeah.
because you are expecting 17% growth from this point. Okay, let's reduce it because 17% growth from this point may not be logically possible. So let's reduce it to 10% for the sake of it, right?
10%.
And now what is the fair value?
Pretty much 550.
Yeah, now and the stock price
Was 507.
right. So would I buy? If I use these calculations, if I believe in my future projections for an 8% return in the next 5 years, yes, I would invest in Meta at
Yeah.
507. And what is my expectation? I'm expecting 50% growth in the next 5 years, which means I want the stock price to be at 750 in the
Yeah.
next 5 years. But what actually happened was the stock price is already at 710. It actually reached 775. It had beat my expectation within 1 year. Now, if I was an
Yeah.
investor, I already got my 50% returns within 1 year. I have a choice now. Whether I either hold on to the stock or I already reached my target, I just sell and get my profits and be happy, right? And find some other investment which would be better than Meta, right?
Man, this is so cool. That is just amazing. Well, thanks for the analysis, and we should look at some other companies in the similar way and see where investors might get some gains.
Yeah. Thank you. Thank you, Natalia.
Bye.